Welcome to this episode number 13 of Your Next Trade. So today we're going to ask ourselves if Santa will be coming soon as the year is almost ending, and we're going to have for this week a very busy week. So let's start immediately with what has been the week and how the asset performances have been. So as you can see, most stocks indexes have been down. The S&P down 3.5%, the Nasdaq down 4%. So pretty much a risk off after having this strong rally from the 3600 on the S&P to the 4100, which we discussed last week at the chart. Very important level. And the market, the equity market, has been really struggling. So risk off. Very much with the US markets underperforming the other markets. What is interesting is you can see that the dollar has not been moving too much, except a bit versus the Japanese yen. Similar cryptos have been not moving much, and at the end of the spectrum, very interesting, and something that we have been underlining is the recent weakness of the WTI, and we look at the contango backwardation of the curve of the WTI, which was not a good signal, and we warned a couple of weeks ago about the potential weakness in the oil and the XLE, and that happened for the week. So WTI down 11% in the very low 70s now, and the rest almost flattish for the other commodities. So what is the week-to-date industries performances? So pretty much as always, when the US dollar is doing fine, so that means we are in a risk off. The other end of the spectrum, you see there is a lot of many changes. Actually, this is a funny shape. On the S&P, which is here, the S&P, and you had really sectors that industries that underperform. So we are talking oil services, energy, really the big underperformers. So which could be explained obviously by oil coming down. So you as well at the end of the year, you might be selling some of the winners if you had some pressure on your portfolio. But I don't think this is the reason. But quite a divergence between the average, which is 3 to 4% for the S&P, and actually the biggest industry that have been coming down much more than that. For the yields, for the rates, so the US 10 years at 358, we are coming from the 430 level, so we have been coming massively over the last 30 days. So we had an 80 bips move, 0.8% on a month. So that is really a big move, where bonds, which were one of the underperformer for the year, actually did very well for the last month. Why? Because the expectation from the Fed has been less hawkish. The inflation is coming down as well. If you look at the yield curve again and again, same story, minus 75 bips roughly. So that gives you a good indication that first, we might have a recession in the US early next year, and I think the consensus is probably around half the year, and as well that the inflation pressure will come down in the near future. Euro dollar. So euro dollar, the picture is more or less the same like it was last week. The terminal rate, which is the maximum rate, is going to be around June next year, 5.5 around 5%, which is 1.5% away from the 10 years. We have the FOMC meeting this Wednesday. The VIX, something that we flagged, we've said that for the year, at least each time that we were going into the low 20s, high 10s, we had a bounce in the VIX when the VIX is bouncing, or when the market is into a risk off, you have this bounce. So now the question obviously is how much of a bounce are we going to have for the volatility? It's a question as well of liquidity, but so VIX at 22.8%. a question mark really if we're gonna have more volatility. The VIX future term structure is a bit flattening from last week. So let's go into the technical analysis. So last week I flagged 3 charts, and I think the story is exactly the same. So the S&P, we flagged the 4100 as a big level, something that really I flagged when we were at 4,000. Then we moved higher. So for the people that are interested in technical analysis, there is a question mark of, you know, if the 4,000 and above was a bull trap. So far that has been the case. We have been really struggling to go above this 4100. As I said before, there is a big positioning with options at 41.45 with the JP Morgan call put structure, and for the week we have been down 3 to 4%. So as long as we stay below this trend that we started at the peak of the market, and we started this year, the trend is more or less the same. This is a downtrend. So that was a squeeze in a bear market. Picture is overall the same. We haven't decided yet on breaking this level, and it's very much the same as the rally that we had over the summer. The only difference that as I flagged last week is you have most of the generals, the Facebook, the Amazon, the Meta, that are down 30% versus the highs from this summer. So literally that explains the 5% difference that you have between the rally that we had recently and the rally in August. Really important picture, same XLI industrial versus the SPY. I'm using exactly the same chart because the story is the same. And finally, just another chart that I want to mention. So this is the CL1 that is for the crude oil for WTI. So we have been making new lows for the year. So we are trading at 71. But I think it's worth putting this chart versus the XLE. And the funny thing is now you have some, I saw JP Morgan and some other strategies that are putting this divergence between here the XLE in orange and the WTI. You see the divergence. So XLE, which is for the oil services, have been doing very well so far versus the underlying, which is the CL1. There is really a question mark: is we going to be closing this gap? So so far holding well. I think that was due to obviously flows going into that sector, kind of a protection, and we know how market participants are. We on average do the same as what the guy is doing next to us. So we are following, and when there is a change in trends, then actually that could be very painful. So really this is the one to be looking at, WTI, because that tells you as well that the world is slowing, and we don't have as much demand as, you know, 90% of the people were thinking even a week ago. So now I want to go back into the Excel spreadsheet and what has been happening this week. So I thought last weekend that actually the week could have been quite boring after the ISM services. We didn't wait long, because from the ISM services, so if you look here, this is the chart here. If you 3 p.m. UK time on Monday, the market has been coming down. So why ISM services? If you look at we went into the 53%. So we have been bouncing on the 50. It's nothing technical here. It's just that the services in the US, which represent 70 to 80% of the economy, 80% of the economy are doing pretty well. Meaning, in other words, good is bad. Why? Because if the numbers are too good, that means the FOMC could be not as dovish as we would like to. So in other words, they could the hiking cycle could not be coming soon. If you look at the prices, which are in the 70s now for the ISM services, still pretty high. Whereas if you look for the manufacturing, it has been coming down very quickly. So The way the market has reacted is selling on the news and carrying on selling. What is interesting and something that I flagged as well is we know that there is a big positioning with options for the S&P. I'm talking here around 4,000. So there is this natural magnet where the market sometimes overshoot on the way up, on the way down, but we come back naturally into this 4,000. So here, this is the 4,000. So we overshoot before, and then we overshoot a bit down here. But overall, the market is trading in this 3,900, 4,100 range for the S&P. I put again the XLE versus the CL1 chart here, because I think this is really the one to be looking at for ID generation. There are tons of trades to do it. So going into next week, I mean, it's going to be an easy week in terms of catalysts. There are tons of them. So we start really the week on Tuesday with the CPI. So CPI on Tuesday. So far, the reaction, if you look at the reaction on the CPI over the last two CPI dates, we moved very nicely, especially you remember the previous one when the market went up 5.5% for the S&P. So we had this fantastic rally. Why? Because the CPI came a bit lower than expected. PPI on Friday, yesterday, was not great either. So telling you that, yes, there is inflation for services. And now, obviously, this is the CPI will be very important for the decision from the FOMC meeting on Wednesday. So what are we expecting on Wednesday? So we are expecting the odds that the Fed fund rates are pricing is plus 50 bips at 75%, and only at 25 bips that is going to be 75 bips. So that's for this FOMC meeting. What is going to be interesting is the way forward. We know based on what we look with the euro dollar that we are getting closer to the end of this hiking cycle. You might have another 50, 75 bips. We know as well that from a couple of weeks ago, Fed Powell said, guys, we need to be a bit on hold and see how this very strong hiking cycle that we started 9 months ago, how the market is digesting the information, the market, but more importantly, the economy. So that means going forward, I think they're not going to be overreacting or as reacting as before. So this FOMC meeting is very important. What we can see as well is how the market has been reacting on the day of the FOMC meeting. So we had a long run where the market reacted very positively on how Powell was talking to the market and looking at the way forward. Over the last two meetings, the FOMC meetings, actually the S&P on the day was pretty weak. So that is, again, that gives you a bit of momentum, that there is a bit less certainty for the market going forward. The market doesn't like uncertainty and very often reacts badly on a day like this one. So 1.7%, a couple of FOMC meeting away, and the last FOMC meeting we went down by 2.5%. And then on Thursday, after this FOMC, we're going to have the retail sales in the US, important because, we know that the US consumer makes 70% of the US economy, and tons of other central banks. So in the world, there's not only the US, you get the ECB, you get the Bank of England, you get Norway, you get SNB with Switzerland. So many rate decision just before Christmas. Friday, we got the flash PMIs for the macro, a bit of earnings over the week, but this big one, which is the OPEX. So on Friday, on the third Friday of the month of December, you get the biggest expiry of the year. Why? Because this is when market participants are closing or reducing most of their positions, and then they are going away for the next 2 weeks. So except looking at 2018, when the market was into a free fall and carried on 5 days later, very often what you have is after Christmas, there is not much happening. And in terms of seasonality for the month of December, which is a positive month on average, you start to see Santa coming for stocks around the 11th, 12th of of December. So starting this week, normally you have seasonality and the market rallied between 1 to 4%, keeping in mind that we are already done for the months. It doesn't mean because we had this in the past that it's going to happen again. So finally, just for the OPEX, and it's not only OPEX, you're going to have some index rebalancing. As I just mentioned before, it's very important to understand the size of the 4,000 natural magnet of the S&P. There is a lot of positioning, open interest. If we fly away far away from this 4,000 on the downside, that means as the gamma will be far away, there is a chance that we might have a strong sell-off. I want to believe, so probably I'm going to be right, that the 4,000 will be this natural magnet, and we might come back to this 4,000. We'll see how this will unfold. What the market has been pricing as of yesterday is the S&P should be moving by 3% for the week, which makes sense versus the 1.5, 2% that we had before. So a lot of volatility to happen, a lot of things to follow. CPI, FOMC meeting, Thursday, a lot of central banks retail sales, and Friday, you're going to see a ton of volume. So volumes will be 2-3 times more than usual. So don't be surprised. It's going to be completely distorting the volumes on your charts. But that's going to be for the week. So for us going forward, what we're going to have, so I think it's going to be the last for the year, your next trade, because after there is not much catalyst. So I think we're going to meet again in the beginning of January. I just set up the IG generation for 2023 webinar, so which is going to be on the Saturday, the 7th of January, 1 p.m. London, 8 a.m. New York. So this is similar to what I've been doing over the last 2 to 3 years. I try to generate IDs across asset classes and as well for single names. And I do a kind of recap of 2022 and what I see interesting for 2023 in terms of ID generation. So both in terms of macro and single names. If you are interested in what I do, either with a 4x4, you can subscribe to the 4x4 until the end of this month with a 25% discount. If you are interested with the mentoring, there are less and less openings available, especially if you are in Asia, Australia, where I dedicate some part of my weekends to those mentees. For Europe, there are 1 or 2 seats still available, so contact me quickly if you want to do mentoring in early Q1 or Q2. So this is it for me for the week. Have a good football game because it's going to be later. It's going to be interesting between France and England. And if you get questions, please feel free to send me an email. Have a good week and then a good Christmas. And we're going to be talking into the new year. All the best. See you soon. Bye bye.